All right, I want you to try a quick experiment with me right now. Open up your brokerage account, Questrade, Wealthsimple, or whatever outdated interface your bank forces you to use, and find that large green figure labeled Total Portfolio Value. See it? Take a long, honest look at that number. Maybe it says $100,000. Maybe it says $1 million. Now imagine grabbing a thick red marker and drawing a bold line straight through it. Why? Because that number is misleading. It represents what's called gross wealth. It's essentially a vanity metric. It completely overlooks the single largest and most expensive liability in your financial life, the Canada Revenue Agency. Most Canadian investors operate under the assumption that they own 100% of their portfolio. But that simply isn't true. You have a silent partner. This partner assumes zero risk, contributes zero capital, yet holds a legal claim to anywhere between 25% and 53% of your gains. And the exact percentage depends entirely on which account you chose when you clicked buy. Let me put this into perspective. You might see a $1 million portfolio on your screen, but if it's structured inefficiently across your accounts, your true after-tax wealth, the amount you actually keep, could be closer to $700,000. That's a $300,000 inefficiency gap created purely by misunderstanding how the tax system works. It's wild when you think about it. People spend decades obsessing over what to invest in, this stock, that ETF, maybe some crypto, but they spend virtually no time considering where those assets should be held. And in Canada, the location of an asset often matters far more than the asset itself. So today, we're going to fire that silent partner. We're going to conduct a complete forensic audit of your asset location strategy using what I call the four-bucket protocol. This is the exact framework I personally use to ensure that when my portfolio grows by $1, I'm actually the one who keeps that dollar. We're going to divide your entire financial life into four quadrants. Quadrant 1, the interest trap. Quadrant 2, the border tax. Quadrant 3, the Trojan horse of Canadian dividends. And finally, Quadrant 4, the Moonshot. If you're currently holding a GIC in a non-registered account or a U.S. dividend stock inside your TFSA, you're essentially volunteering to give the government more of your money than necessary. Let's correct that. We'll start with Quadrant 1. The most common mistake I see by far, the interest trap. This bucket includes anything that generates interest income. We're talking about GICs, high interest savings account ETFs like cash.to, and both corporate and government bonds. But before we go further, I need to make a very important distinction, because this is where confusion always creeps in. There is a major difference between your emergency fund and your investment portfolio. If you're keeping cash in a high-interest savings account because it's your safety cushion, your rainy day reserve, that's perfectly fine. Keep it liquid. Do not tie up your emergency money in a volatile bond fund just to shave a percentage point off your tax bill. That's not the objective here. For emergencies, liquidity comes first. However, and this is critical, when it comes to your long-term investment capital, interest income is, from a tax perspective, the least efficient type of return you can earn. The CRA treats every dollar of interest exactly the same as employment income. It's fully taxable at your highest marginal rate. There's no dividend tax credit, no capital gains inclusion discount, nothing. It's fully exposed income. Let's walk through the math because this is where conservative investors often get hit the hardest. Imagine you're a high-income earner in Ontario, sitting in the top tax bracket. You purchase a GIC paying a seemingly attractive and safe 5% yield. You think, great, I'm keeping ahead of inflation. But are you really? In the highest bracket, your marginal tax rate exceeds 53%. So on that 5% return, more than half goes straight to the government. They take roughly 2.65%, leaving you with just 2.35% after tax. Now consider inflation. Even at a modest 2.5%, your so-called safe investment is actually eroding your purchasing power day after day. You're locking up your capital. You're taking on the opportunity cost. And the government is walking away with the majority of the yield. It's absurd. So where should these assets be held? The audit rule is straightforward. Bucket 1 assets belong in your R RSP. Full stop. Your registered retirement savings plan functions as a tax deferral chamber. Think of it as a vault. When you hold that 5% GIC inside your RSP, the CRA doesn't get a cut this year. They don't get a cut next year. That full 5% continues compounding year after year, untouched by taxes for decades. You only pay tax when you eventually withdraw the funds, ideally years later, when you're retired, relaxing somewhere by the water, and your marginal tax rate has dropped from 53% to something closer to 20% or 30%. What you're doing is essentially tax arbitrage against the government. And in that scenario, you come out ahead. Now, I know the next question. What about the TFSA? You can hold GICs there too. Yes, technically you can, but that doesn't mean you should. You could also use a Ferrari to tow a boat. It would function, sure, but it would be a ridiculous misuse of something extraordinarily powerful. Your TFSA contribution room is arguably the most valuable real estate in the entire Canadian financial landscape. It's limited, and once it's used up, it's used up. Filling that precious space with low-yield, ultra-safe assets like GICs is a massive strategic error. Your TFSA should be reserved for assets with serious upside potential, investments that could double, triple, or even go up tenfold, because every dollar of growth inside that account is permanently tax-free. Locking that space up with a 4% GIC is not just inefficient, it's a complete misallocation of one of your most powerful tools. Now let's move into quadrant 2. And honestly, this is where I see self-directed investors consistently burning money without even realizing it. We're talking about U.S. dividend stocks. Think Coca-Cola, Johnson & Johnson, or those popular U.S.-listed dividend ETFs that pay attractive monthly distributions. Here's the typical thought process. You open your TFSA and think, I love this account. It's tax-free. I'll load it up with U.S. dividend stocks so I won't owe any tax on the income. It sounds logical, but it's completely wrong. The TFSA is a Canadian invention. The IRS in the United States does not recognize it as a tax-sheltered account. To them, your TFSA is just a regular brokerage account. They don't acknowledge its tax-free status at all. So when a U.S. company like Coca-Cola pays a dividend into your Canadian TFSA, the IRS intercepts that payment before it even reaches your account and withholds 15%. This is the foreign withholding tax. If Coca-Cola declares a $1 dividend, only 85 cents actually arrives in your account. And you might be thinking, no problem. I'll just claim the foreign tax credit and recover that 15%. You can't. Because the TFSA is tax-free, you don't report its income on your tax return. And since there's no reported income, there's no way to claim the credit. That 15% is permanently lost. It simply disappears. You've paid tax that you never needed to pay. So where should U.S. dividend stocks be held? The audit rule is straightforward. U.S. dividend-paying stocks belong in your RRSP. Here's why. Canada and the United States have a tax treaty, essentially an agreement between the CRA and the IRS. Under that treaty, the IRS recognizes the RRSP as a legitimate retirement account. If you hold that exact same Coca-Cola stock inside your RRSP, the withholding tax is waived. You receive the full $1 dividend. The RRSP is the only place in the Canadian system where you can legally avoid that U.S. withholding tax. If you currently hold U.S. dividend stocks inside your TFSA, you are quietly giving up 15% of your yield for no reason at all. Move them. Shift them into your RRSP. Now let's move to quadrant 3. Canadian eligible dividends. This is your traditional blue chip territory. The major banks, pipeline companies, telecom giants, the core pillars of the Canadian economy. The government wants Canadians investing in domestic companies, so they offer a generous incentive called the dividend tax credit. Because of this credit, eligible Canadian dividends are extremely tax efficient. In some provinces, if you have little to no other income, you could earn up to $50,000 in eligible dividends and pay virtually no income tax. It's incredibly attractive. That's why many advisors suggest holding Canadian dividend stocks in a non-registered cash account. And generally speaking, that advice makes sense. If your RRSP and TFSA are already maxed out, The non-registered account becomes the logical home. It's far more efficient than holding interest-generating assets there. But there's a hidden catch. I call it the Trojan horse. Here's how it works. While the actual tax payable on those dividends may be very low, the income that appears on your tax return is artificially inflated. To provide you with that generous dividend tax credit, the CRA applies something called the gross-up mechanism. They take the cash dividend you received and increase it by 38%. So if you actually received $1,000 in dividends, your tax return will report $1,380 of income. You never receive that extra $380. You can't spend it. It doesn't exist in your bank account. It's phantom income. But here's the critical part. The CRA uses that inflated number to calculate your official net income for the year. And you might be wondering, why does that matter? It matters enormously, because nearly every government benefit in Canada is income tested based on your net income. Think about that for a moment. If you're retired and receiving old age security, and your income is approaching the clawback threshold, roughly $90,000, that gross-up mechanism can cause serious damage. You might look at your actual deposits and assume your income is $85,000. Safe. Under the limit, no problem. But because of a sizable dividend portfolio sitting in your non-registered account, the CRA inflates your reported income to $95,000. And just like that, the clawback kicks in. The government starts reclaiming your OAS at a rate of 15 cents for every dollar above the threshold. Yes, you saved a bit on income tax thanks to the dividend tax credit, but in exchange, you sacrifice part of your pension benefit. That's not a great trade. So here's the audit rule. Canadian dividends are excellent in a non-registered account while you're accumulating wealth. But once you're retired, and especially if your income is anywhere near the OAS cutoff, you need to manage them very carefully. At this point, I can almost hear the gears turning. You're thinking, this is powerful information, but how do I actually keep track of all this in real life? And that's a fair question, because execution is where most investors stumble. Your brokerage dashboard alone isn't enough. Some people try to manage everything with spreadsheets, but those are often full of small errors that compound over time. They fail to properly track phantom distributions, like reinvested ETF capital gains that generate tax even though you never receive cash. They mishandle currency conversions for strategies like Norbert's Gambit. And worst of all, they frequently miscalculate adjusted cost base, which is absolutely critical when reporting capital gains accurately. Relying on a generic spreadsheet template, or worse, assuming the T5008 slip from your broker tells the full story, is a fast way to file an incorrect tax return. So to address this exact problem, we're developing a new tool called the Canadian Wealth Tracker. It's being built from the ground up with this audit-first framework embedded directly into it. It will connect to your accounts, automatically flag inefficiencies, and monitor all of those complicated variables to calculate your true net worth, the number you actually keep after taxes. If you want to stop guessing and start having clarity, we'll be opening access to a beta group very soon. Make sure you're subscribed and watch the community tab for that announcement. Now we have one final bucket to cover, and this is the exciting one. Quadrant 4, pure capital growth. We're talking about assets that pay little to no dividends at all. Think high-growth technology stocks, growth-focused ETFs, maybe even Bitcoin ETFs. The objective here isn't monthly income. The entire strategy revolves around price appreciation, buying something and watching its value climb. So the big question becomes, where should these high-growth assets live? The answer comes down to asymmetric upside. Let's walk through it. If you place a high-growth stock inside your RRSP and it appreciates by 1,000%, that's an enormous win on paper. But you've also created a massive future tax liability. When you withdraw that money in retirement, every dollar is taxed as ordinary income. You've effectively converted what would have been a capital gain, normally only 50% taxable, into fully taxable income at 100%. That's not efficient. It's a mathematical disadvantage. What if you hold it in a non-registered account instead? That's better. You'll pay capital gains tax and only half of the gain is taxable. But you're still surrendering a meaningful portion of your profits. Now consider the TFSA. This is where everything changes. If you invest $10,000 in a stock inside your TFSA and it explodes to $100,000, that entire $90,000 gain is yours, completely tax-free, forever. You can withdraw the full amount, spend it however you want, and the CRA receives nothing. So the audit rule here is crystal clear. There's no ambiguity. High growth, high upside assets belong in your TFSA. This is precisely why you never waste valuable TFSA contribution room on low-yield conservative assets. The TFSA is for your moonshots. It's where you take calculated swings at transformative growth. Because if you hit it out of the park, you keep every last dollar. But there's one more wrinkle. Of course there is. With the CRA, there's always a hidden catch. What happens if you get a little too aggressive inside your TFSA? What if you start day trading, buying and selling constantly, basically running your TFSA like a full-time operation? In that case, the CRA can step in. They can audit you, and they have the unsettling authority to label your TFSA activity as a business. And if they make that call, all those tax-free gains instantly lose their special status. They can be reclassified as business income and taxed in full. It's a powerful and frankly intimidating lever. And the truth is, most people have no clear idea what behaviors actually set off those warning signals. That's why I put together a full deep dive on TFSA audit triggers. In that breakdown, I walk through the specific patterns the CRA tends to watch for when they decide someone has crossed the line and doesn't deserve tax-free treatment anymore. So if you plan to use the Moonshot approach, you absolutely need to watch that explainer next, just to make sure you stay safely on the right side of that boundary. And look, if this audit helped you in any way today, do me a favor and hit the like button. It tells the algorithm this is worth sharing, and it helps get this information in front of more Canadians who are, right now, unknowingly donating part of their wealth to the CRA. And if you haven't subscribed yet, make sure you do, so you don't miss the launch of the new wealth tracker when it drops. One last thing, as always, I'm just a guy on the internet. I'm not your accountant. So don't treat anything you heard here as personal advice or a direct prescription for your situation. Do your own due diligence, make your own decisions, and double-check the details for your specific case. Thanks so much for watching.